topic today, one of extreme interest to a number of investors in current markets and one aligned with an ETF launch completed on our markets earlier in May. We're going to take you through a primer on target outcome mandates, in particular, one launched with Cboe Canada via First Trust. We'll get into the details in a moment, but I'm thrilled to be joined by two individuals today on our digital hot stove. Please meet Carl Chong, Head of Distribution at First Trust Canada, and Dan Sullivan, VP Business Development from Cboe Vest. Carl, Dan, thank you very much for joining me today.
Thanks for having us.
And thanks, gentlemen, obviously from our perspective, thanks for sharing a bit of time this afternoon to share your insights, knowledge, and information with our investor base. It's a topic that I'm sure is only growing in popularity these days. I know we've been receiving a lot of questions on the topic of target outcome and broadly covered call mandates overall, but also something near and dear to our hearts here at Cboe Global Markets. So keen to have you with us. For the group, quick housekeeping. You're here for 30 minutes. Try and keep it on track today, despite, I'm sure, some growing interest in the topic. Ask your questions in the chat box below. Promise we'll answer them and work them into the discussion. Otherwise, we'll make sure we leave some time for you at the end. And if you're new to joining us today, do make sure you follow us on social and not to miss out on updates, as we'll be posting this recording and others online later on this afternoon. Then to the topic at hand. Carl, obviously very excited to see this new ETF out in market as from May, and I thought might make for a good opportunity for you to quickly reintroduce the First Trust Canada team to our investor base, and in particular the relationship with Cboe Vest for context on why we're here.
Yeah, thank you, Eric, and I appreciate the time here. So I help lead our Canadian business efforts with a group of sales professionals with their sole purpose of really just servicing and supporting the investment advisor. And we do that with thought leadership. So we have some of the most read and most shared research on the economic and research side, practice management. So we're really dedicated to supporting and servicing the advisor and helping them growing organically. And then lastly, with differentiated products. And this is right up the alley of buffer ETFs that have exploded in popularity, really a brand new category that was created in 2019. We actually launched the first buffer ETF here in Canada in August 2019. And it has since grown tremendously across the industry, across a few providers, with First Trust being one of the leaders. In terms of the buffer ETFs and our partnership with Cboe Vest is the asset management arm of Cboe. Of course, I don't have to explain to this audience. But they pioneered the concept back in 2012 and then launched the first mutual fund with a target outcome concept. They have been tremendous partners to us on educating the market and delivering outcomes throughout that period. So we're really excited to be here today.
Right. Thanks, Carl. And broadly speaking, and just in case the audience isn't completely up to speed with us, how do buffered ETFs or target outcome funds really work? And what's their objective versus a traditional ETF that we might all just be investing in with a long only objective attached?
Yeah, it's really important not to overcomplicate this type of product. Essentially, what we're doing at the highest level is we're taking structured returns that have been in the market for decades, right? So this is not a new type of return outcome that's being offered. The real magic is happening is because we're taking those returns that have typically been in structured products or annuities, and we put it in the ETF wrapper. And by doing that, what we offer investors now is more transparency, more liquidity. When you think about some of the other products, if you were to redeem in a stressful environment, you might pay heavy penalties or you might not be able to get out at all. And then more importantly, for Canadian investors, we change the taxation by having it in ETFs. And these other products are going to be treated on interest income. These products are traded on capital gains, so about half the tax. Now, what we're doing underneath essentially is what we're taking a well-known index, take, for example, in our suite, the S&P 500, and basically putting together a package that gives you a known buffer in advance before you know. So as an investor, when you think of traditional investments, you invest in the S&P 500. It might go up, it might go down, depending on the timing, and you're just carried away with the whims of the market for the most part. Over the long term, of course, it's worked out. But this instrument gives you a defined outcome. You know in advance, based on what the S&P 500 does, what your outcome will be. So we take an S&P 500, we give a downside buffer of 10%, that's known in advance, up to a cap. So if the market is down 8%, you will get your money back gross of fees over the 1 year if you invested at the start. So, it really adds an element to the marketplace that didn't exist. Certainty in a very much an uncertain environment, whether it's fixed income or equity.
Tremendous. And I think, we're going to unpack this whole concept quite a bit more. That gives everyone a really good view, at least on the ambition of the ETF and some of the key benefits you bring out to market. Dan, I want to pull you into the conversation here, and speaking about the recent launch, can you give us some color on the ticker launched with First Trust? I know the symbol's Buffer, BUFR, so 2 thumbs up on ticker convention, obviously. How does it work specifically, and what's actually different? As the expert in the room, lead the way.
Sure, and I'm thinking it might be helpful to share my screen quickly, just because sometimes it's helpful to see a visual. So I'm going to just pull up my screen really quickly. And let me know if you can see that all right. Perfect. So what we have, with our offerings, we have our point-to-points available. And those are going to give you exposure to the S&P with protection on the first 10% on the downside, with a cap on the upside. And that's determined by the call option we sell to pay for that downside protection. And we have it for 4 different months. So for example, the August, we're going to trade that on the 3rd Friday of August, and it's going to go out to the 3rd Friday of August the following year. So it's a 1-year outcome period. And we have 4 of these. What we do for BUFR is we pretty much just put all 4 of these into one fund, and that's BUFR. And the benefit of that is it diversifies the timing. So you don't have to be in the right one at the right time or worry about getting out at the wrong time. So that's the key benefit. It's like diversifying that timing risk, making it very scalable, easy to implement across multiple portfolios or within models. A lot of advisors we speak to, they're going towards efficiency, want to be scalable. And BUFR is that kind of strategy that can be a core allocation within your strategic asset allocation. And the other benefit is that because we're rolling it over on a quarterly basis, this 10% protection is always following, right? Say the market gapped down and you were in a point-to-point type product. If it's below the 10% buffer, you have exposure on the downside. But with BUFR, you're having this new 10% protection established, and the caps on the upside are adjusting to the current market conditions. And so with all the volatility and interest rates, the higher interest rates, we're seeing some of the higher caps we've seen, just allowing us to participate more on the upside. And so you just know you're always establishing a new downside protection and a new upside cap. And so it just, again, makes it very scalable, easy to implement. So I hope that was helpful. It has a 0.6 beta to the S&P. So folks are using it as a low volatility hedged equity solution within their equity bucket.
That's great positioning to have in mind. I just want to repeat something, because actually one of the questions I was going to ask you separate to the slide showing up on screen. No, it's an important one. So you've actually got products that advisors and investors can time themselves into if they want a specific months or quarters worth of coverage. But Buffer is in fact wrapping all of these together. So it's a one-ticket solution to go and get the kind of protection that you might be looking for in these kinds of markets.
That's exactly right. And for the point-to-points, we started on the US side, we started with the point-to-points, and we have a lot of clients still using point-to-points. They're still very popular, especially for larger clients, or if you want to be tactical, if you want more upside exposure, you can look at First Trust website. It's a great resource, and you can identify which one of these is going to give you the most upside, or vice versa, which one's going to give you the most downside. But we have a lot of advisors who are growing their books. They have new money coming in and at different times. So one client might get into OGB.F, and then you have another client should 5 months later, should they go into the same one or they should go into Fed B.F? BUFR kind of mitigates that and allows it to just be easier, more scalable. And so we have clients using both, but BUFR is certainly our largest fund on the US side. It was the first buffer ETF to go over $1 billion in assets. And I think it's really just because it makes life easier.
It makes sense. We're all looking for ways to remove overhead from our day-to-days, and this seems like an interesting way to do it. Obviously, Dan, buffered ETFs been around for a while, or target outcome ETFs been around for a while. Can you talk to us a little bit about your business and how you and the team developed this specialty in target outcome in the first place? I think that's something that our audience would like to hear about.
Sure. I wish I could take more credit for actually creating it, but I will say our co-founder, he was with a large bank on the structured note team, and 08 happened, and he looked at these strategies and said, there's nothing wrong with the options themselves. It was the banks that had the issues. It was their balance sheets. That was where the liquidity crisis was coming from, not from the options. There's ample liquidity in the options market. So they would be great if we could put this type of product, like a structured note type of product, but in an ETF or mutual fund wrapper, where you still have this benefit of getting that downside protection, having the upside exposure, but put it into this wrapper where you can have full flexibility, liquidity, transparency, and use exchange traded options that clear through the option clearing corporation. So you don't have the direct bank credit risk that if something does happen like 08 again, you don't need to worry about that. All of our options are traded and cleared by the option clearing corporation. And at the end of the day, really our goal is to deliver more predictable investment outcomes for our clients. So by the use of options, they'd be very powerful tools if you use them in the right way. We're very rules-based, systematic. We don't try to time the market. And so our goal is to just deliver these more defined risk-return profiles, add additional diversification to your already diversified portfolio.
Thank you, Dan. I heard transparent. I heard easy to use, easy to access. And ultimately for investors, diversify and manage your risk as a few key takeaways from your comments there, and something that I'm sure in this environment everybody is watching for. Now, Carl, these types of funds certainly more sophisticated. Just thinking about the kind of strategy running underneath the covers on a listed ETF. Carl, can you give us a bit of a view when you're out talking with advisors and certainly their investors today? What is actually a good outcome for a target outcome ETF in today's market? And Dan, I'm coming back to you for the opposite end of that question as you're kind of getting ready for the next question.
And really the catalyst that has happened over the last several years, especially with the advisors, is that advisors are starting to realize for the first time that bonds can be risky. And I think in 2022, that was quite a shock. So the bonds were down double digits alongside the equities. And historically, those client conversations have been that bonds will provide a ballast and offset equity market declines. And we were in a perfect storm environment where that didn't transpire. So advisors needed to start looking at a different category. And that's where the essence of this, where this can be a tool there. This product really is brought to market to be purchased and held throughout time. And when you take a look at like risk management products in the marketplace, so Dan mentioned low volatility, but we also have lots of concepts like switching strategies, going from equity to cash, that we've seen that as a popular trade this year, or just even private debt and private real estate that can be illiquid at times. So these strategies all have a place in a portfolio. They all tend to work, however, until they don't, where redemptions might start getting gated in the private debt world, or the low volatility strategies tend to overweight the wrong sectors of the market. So they're falling just as much as the overall marketplace. And so we feel this is a great tool that we brought to market for the advisor community to buy and hold, because you have a predefined outcome from the start. It's not based on any correlations historically between bonds and stocks. It is really a forward contract. Really, you make a deal up front. And if you're okay with a 10% buffer, or like in our case on the Cboe Canada Exchange, a laddered buffer concept giving you 10% downside protection with the underlying up to a cap. I think it'll really be a good product to hold longer term for them. And we've seen it this year. We were talking earlier before the start of this, is that everyone came into this year extremely bearish. Every wirehouse in the US and every Canadian bank had a bearish forecast for the most part. And we're, including First Trust, and we were all wrong. The market, as you know, has produced double-digit returns and over 30% of the NASDAQ. This type of product doesn't take that type of bet, because right now we've seen lots of investors and advisors start to move to the cash market, and we're seeing a similar trend. Everyone's going in the same direction. Now, if you look back year to date, these type of products are generating returns of double digits, 13, 14%, depending on the buffer, or if you look BFR in the US. Meanwhile, cash is giving you that 4 or 5% and fixed income 1%. So this has been a better outcome for investors right from the beginning without having to take market bets, because none of us, you and I, Eric, Dan, can predict where these markets will go going forward. And then that's going to be a truism with so much uncertainty in the marketplace.
I wish I could.
Wouldn't that be the dream?
Yeah.
Dan, give us the contra case, like, for the expected outcome. Obviously that's there in our ambitions. What can go wrong? What does that look like from the perspective of an investor or for an advisor?
Yeah, I can take it from like the credit side, and then I can go to the performance side. On the credit side, I mean, I mentioned this, but all of the options we use are clear through the option clearing corporation. So there is no direct bank credit risk. Theoretically, the OCC could go under. That would be the worst case scenario. They operate under the jurisdiction of the SEC, the CFTC, going back to 1973. So they are held to higher credit and liquidity standards. So, I mean, if they go under, I mean, the financial system would be in serious trouble, but that would be the worst case scenario on the credit side. Now, for the performance side, the past 10 years before last year were essentially challenging markets for any type of product where you're getting downside protection and you're giving some of the upside. Because when there's no volatility and there's zero interest rates, and I should just take a step back, the two main drivers determining the cap levels are volatility and interest rates. So higher the volatility, higher the caps, higher the interest rates, higher the caps. So when we had 0% rates and no volatility and the market just goes straight up, we're not going to perform as well. We perform really well in sideways markets or slowly climbing markets, and then down markets. So last year was perfect, perfect example of when we're going to perform best. And I tell advisors, when the market's really rallying, that shouldn't be, we're not a growth oriented strategy. We're here to provide you with that protection, more predictable outcomes. So you can think of, I use the analogy like car insurance, home insurance. You buy that to sleep better at night. And by having the buffer ETFs, you can sleep better knowing you have some of this downside protection, and allows you to take more risk with the rest of your equity portfolio. So when the market really does go, then hopefully the rest of your equity portfolio is doing really well. And then we have a market like last year, as Carl said, it's very difficult to predict. I didn't know that was going to happen. So then all of a sudden the buffer ETFs, that's when you need them the most, and they're going to deliver. So I hope that was helpful.
That is, and in the right market, maybe to ask the question in a different way, not that you didn't answer it completely the first time, but safe to assume that the buffer ETF could be treated almost as a core portfolio holding and complementing other things that you may have in your portfolio to sprinkle in market risk or emerging markets or other types of asset allocation strategies you may wish to bring in.
Yeah, absolutely. And I think that if you have a low volatility hedged equity bucket within your equity, or I should say low volatility hedged equity sleeve within your equity bucket, a lot of folks are using it there, or just taking 10, 15, 20% out of their large cap equity exposure and using the buffer ETFs as a way to gain or maintain exposure, but taking some risk off the table. A lot of uncertainties in the market right now. Are banks, the central bank's going to continue raising rates? Is there going to be a recession, soft landing? What's going to happen with inflation? A lot of uncertainties. By having these target outcome type of products, you just have more certainty. You have that downside protection, still have plenty of upside participation as well. So it's just a good way to either get back in the market or maintain exposure, but with lower volatility, lower drawdowns, that smoother ride. What advisors are also doing is, say you have like a 60-40 type of portfolio, a moderate investor. What they're doing is taking some out of equity and some out of fixed income and using BUFR or the point to points as a substitute, because they have a 0.6 beta to the S&P. So very similar risk return profile as a 60-40 portfolio. So you lower the risk on the equity side, you enhance the returns on the fixed income side without introducing any additional duration or credit risk. And holistically, you're not changing the risk return profile of the portfolio. So there's a few different ways to use it. I'd say the most popular, though, is within that large cap equity. Right now, we're seeing some of the largest allocations we've seen just because people are nervous with the market. Say you become more bullish and you want to be more growth oriented, then maybe you scale back on the buffer ETFs, go more growth oriented. If you're nervous, then you increase your allocation. So right now, I think people are just nervous, so we're seeing higher allocations. So I hope that was helpful. I'll turn it back to you.
That's perfect, Dan. Thank you. And Carl, knowing you and the First Trust team are obviously frontline on the Canadian front, having these conversations with advisors today, is your discussion aligned with what Dan is sharing? Are you hearing other reasons to kind of jump into the buffer ETF product today, given the conversations you're having near real time with the financial advisory community in Canada?
Yeah, and that's where we've seen some traction here is primarily with the discretionary advisors that are making decisions across the whole book of business. And actually, just stepping back and before I forget this thought here with Dan's comments, and there's another component to the allocations. It's been based on the client's age. So, for example, these products have become extremely popular for clients that are near or at retirement. You can understand these are generally successful entrepreneurs, business people that the advisors are servicing, high net worth advisors are servicing. And these people don't want to take equity market risk fully with their portfolios. They don't want to make their money twice either. So they're willing to sacrifice a small portion of the upside. Okay, and there's no free lunch in investing. So with these downside known buffers in these products, you are going to have to give up some upside. But these caps, as Dan had talked about, are 18, 19% upside. So if your client's willing to accept a 16% return in the S&P 500, what I feel a lot would, but have known downside protection insurance, that's kind of the trade-off on that front. So with the majority of the money still in the retirees' hands, these are just perfect products. But even on the younger demographics, going to that, I mean, we all, I consider myself younger, but I'm not, I guess. But when you have the younger demographic, your younger audience than the 20s and 30s, and they want to play meme stocks and lots of headline name stocks that you've seen in the market since the pandemic really started, GameStop and others. There's actually a movie, a TIFF here about it. So, if they want to play that, that's high equity risk. We're talking betas of 3, 4 multiples in the market. Tesla is an example as well. You can see the volatility on the up and down in that type of name. And so you have these very popular names that you could play alongside, but this is a portion of the portfolio, going to your point, that could dampen the volatility and act as a little bit more core and sane. At the end of the day, if you're going to follow the best investors, you follow Warren Buffett, they recommend most people just buy the S&P 500. This is S&P 500 with guardrails. And so part of it is that, with advisors, if there is going to be a challenge with them, this is really explaining this concept to the clients. I'm hoping some of the anecdotes and some of the information, but the key really of just like keeping the client invested throughout time. Dan, I don't know if you could just pull up that chart. I think it's a very powerful chart for your viewers to show you. It's something the industry tends to show quite a bit. You can see just in this chart here, by staying fully invested and just missing the best 5 days in the market, the best 10 days, you basically cut that return down in half. And this is really a great tool for advisors to introduce to their clients. So, I want to get back into the market. I don't really know how to get into the market at this point because everything's so uncertain. Well, we're providing guardrails on the deepest, best performing market in the marketplace. We can do it in a single ticker with BUFR, as we have listed on Cboe Canada, to give you a smoothed out ride. But at least we don't miss these days in the marketplace, which is impossible to time. Again, going back to that timing question, and giving up half our return over that point. So there's lots of wealth that I feel are going to be left on the table, sitting on the sidelines, sitting with 3, 4, 5% cash. That's happening now, and I think, given First Trust inflation forecast and the outlook for the economy, we're going to try to seek gains like outpacing inflation, which I think cash over time has had a hard time doing.
And this is an important one for any investor, whether they're getting started, to your point, Carl, or well through their financial journey. Time and market usually far more significant than timing the market, to use an old adage. So something for everybody to keep in mind. Keeping mindful of time. Speaking of the opposite, time flies. But a couple of quick hitting questions from the audience. Dan, first one for you. What's the difference between buffer and other target outcome products?
Sure, I would say, transparency, flexibility, liquidity, right? They're an ETF, so they trade and appear on your client portfolios like any other ETF. So they have the full transparency, liquidity. First Trust website, you can always go, you know exactly where you stand, you know what the holdings are. So very transparent. I'd also say perpetual structure, like other structured note type of products where you're getting that defined outcome with the downside protection, upside cap. Those might have a 2-year maturity. Both BUFR and our point-to-points, they're perpetual structure. So they just roll over at the end of the year. A new 10% buffer is established with a new cap, and it just goes out to the following year. And so it's perpetual. You don't have to worry about it. You could theoretically just stay in it and nothing would happen. And so that just makes your life as the advisor easier because it's scalable, easy to implement across multiple portfolios. So I think that's where we see a lot of interest, using it as a complement or a substitute to structured notes, annuity type of products, because some of your larger clients, a structured note can make a lot of sense. Don't get me wrong. You can be fully customizable. These are products and they're off the shelf, but you also want to be scalable and have it easier to implement. This allows that for you. So I'd say those are the key differences, and that we use options that are exchange traded. So we do not have that direct bank credit risk.
I like it. Good reminders for the crew. Carl, you touched on it at the beginning of the presentation, but buffer from a Canadian tax perspective, certainly some advantages that way. Something quickly to highlight.
Yeah, absolutely. And what I was referring to there, as well as in comparison to structured notes, as everyone on this line would recall, the federal government changed the taxation on those notes. And this is like a massive industry in Canada. I think the numbers I saw from RBC looks like 35 billion of structured notes of bought. So these are huge allocations and advisors' books of business. And we're a country that tends to be a little heavier taxed. And so we're looking for angles there to improve our after-tax returns. And this is a great way of doing it. And we do that really, not to get into the nitty-gritty here, but we're using options, flex options on an ETF, which allows us to give us that taxation treatment, very favorable in terms of capital gains. So I think that's a win for the end investor in this type of product.
Stunning. And one last one on the product. It's, well, maybe two. Does it distribute any of its income to shareholders in the form of a dividend?
No, the dividend, Dan, I'll take this one. The dividend is actually, we're tracking the price return of the S&P 500. The dividend is actually, the higher the dividend, it will be higher the cap. That's not a form of payment to First Trust, or it's a fully funded structure and it's non-levered. And what we do is we take that dividend. And so if the dividend's 2-3%, we'll just have a higher cap as a result of that. And that just gives the investor more upside.
Beautiful. And then one of my ETF favorite questions, on the note of busting out some myths while we're at it. How liquid is the buffer product listed in Canada?
Dan, you want to tackle that one?
Yes, I would say very liquid. Any product any fund, the liquidity of that is driven by the liquidity of the underlying securities. And the average daily notional volume of options traded on the S&P is 500 to 600 billion daily. So there's just so much liquidity out there. I mean, COVID hit, for example, the Fed had to come in, buy investment grade credit. There was a credit crunch. Options liquidity actually increased. And so there's just so much liquidity that that's not an issue. If we're coming up to capacity on any of our strategies, we would be very, very excited, put it that way. I don't, that will be far in the future. So the liquidity is ample.
Beautiful. And that's both expected and not surprised, and something obviously we continue to remind both the advisor and investor community in Canada. You know, liquidity underlying is what matters. The actual options market for the S&P, huge. And that's really the key part, I think, to deal with. Gentlemen, it is truly amazing how quickly 30 minutes rips right by. Maybe look, Carl, quickly at you, if there's anything you wanted to leave behind as something to drop into our investors' ears before we mute your microphone and disappear from lunch hour.
Absolutely. I just want to mention there in terms of trading, again, I have a team here willing to support. Just please visit our website. Like as Dan mentioned, there's fantastic tools, great educational material about these products. For those advisors, investors looking to learn more, we're here to help and educate. It's www.firsttrust.ca. It'll be right on the landing page, and we're here to help.
Superb. We'll make sure we link that on the post out. Dan, last round to you.
No, I just thank you everyone for your time. And I think right now the buffer ETFs are well positioned to play defense and offense at the same time and add more predictability when there's a lot of uncertainties in the current market. So really appreciate everyone's time. Thank you.
Brilliant. Well, the one that stuck for me was the S&P with guardrails. I really like that, and I'm sure we're going to see that all over the place from here. But Carl and Dan, to you both, it's been an absolute pleasure having you here with me today, and confident our audience got a lot of the presentation. I really appreciate you taking the time to sit down digitally, share some insights, current thoughts in the business, things that advisors and investors should ultimately be thinking about when they're figuring out how to tilt their portfolio back into the market. And hopefully that happens sooner rather than later. So we look forward to welcoming you both back to the market soon enough. Thank you for joining us. And to our audience today, if you've got any questions, as Carl and Dan have both mentioned, both very open to questions, feel free to drop a line in, and we look forward to hearing from you all soon. So Dan and Carl, thanks again. This is Cboe Canada signing off. Have a great afternoon.
Thank you, Eric. Thanks, everyone.
Take care.